A plot twist. It's the hallmark of every great story. A sudden, unexpected shift that leaves us questioning everything we thought we knew. It's a term born in literature and theater, yet today it resonates far beyond the stage or page. In modern finance, it feels like we're in the middle of our own plot twist, written not by a novelist, but by the Federal Reserve. Since the November election, the Fed's policy projections have taken an abrupt turn. The markets have noticed, sparking reactions across sectors. But with new data surfacing, one question echoes louder than the rest. Why? Why the sudden pivot? The Federal Reserve's decisions ripple through borrowing rates, precious metals markets, and the broader economy, influencing everything from mortgage payments to the price of gold. And yet, their more recent moves appear to deviate from the usual playbook. Are we truly heading toward rate cuts in 2025, or is this a red herring? Could an unspoken crisis be driving these shifts, altering the rules of the game as we know them? Before we start, please hit that subscribe button if you enjoy balanced and insightful takes on the stories shaping the world of precious metals. Your support means we get to keep making these videos. Thank you. To unravel the Federal Reserve's recent policy shifts, we need to rewind to the early days of the pandemic. The COVID-19 outbreak brought the world to a standstill, prompting governments to deploy billions in stimulus directly to households. This flood of money stabilized the economy, but also ignited inflation levels unseen in decades. Initially, the Fed dismissed inflation concerns, labeling them transitory. But by March 2022, they could no longer hold that line. Inflation's persistent grip forced them to pivot, embarking on the most aggressive rate hike cycle in their history. By July 2023, the Fed declared their rate hiking efforts complete. The cuts, however, didn't begin until September 2024, just a few short months before the November election. And that's where things get peculiar. In their final meeting before the election, the Fed projected 4 rate cuts for 2025, a forecast that gave an instant boost to stocks, sent gold prices soaring, and eased mortgage rates. But the tone shifted just weeks later. In December, Fed Chair Jerome Powell walked back the optimism, signaling a reduction in planned cuts from 4 to 2. What's behind this abrupt change, the data or something else? For those keeping track, the Federal Reserve made a significant policy shift in just 6 weeks. This rapid revision of expectations is anything but typical. The Fed usually strives to maintain consistent messaging to avoid unsettling the markets. Such a drastic pivot, from forecasting 4 rate cuts to just 2, introduces a level of uncertainty that leaves both investors and analysts searching for answers. What could have prompted such a change? To understand, we must revisit the Fed's dual mandate, maintaining maximum employment and keeping inflation low, with a long-standing target of 2%. Neither goal appeared to warrant this sudden adjustment. During an October press conference, Fed Chair Jerome Powell addressed the labor market, stating, "The labor market is actually in solid condition, and our intention with our policy move today is to keep it there." You could say that about the whole economy. According to the Bureau of Labor Statistics, unemployment hovered consistently at 4.1% or 4.2% for the last 7 months of 2024, showing little to no change even into December. In fact, Powell himself has noted that any unemployment rate around 4% reflects a healthy labor market. With no alarming shifts in employment, the focus turns to inflation. While inflation remained above the 2% target, it showed little variation in the critical 6-week period. Data from the PCE Price Index reported September and October readings of 2.1% and 2.3% respectively. Even the core PCE, which excludes food and energy, changed minimally, registering at 2.7% in September and 2.8% in October. In summary, the labor market remained stable, and inflation showed only a slight uptick of 0.1% during the period. Yet the Fed's policy stance shifted dramatically, causing a noticeable drop in the spot price of gold. There's a missing puzzle piece, and there are no clear answers, but there are some respectable theories. Now, some viewers might argue that the November election played a consequential role in the Federal Reserve's sudden shift. After all, Donald Trump's landslide victory signaled a potential return to policies with inflationary implications, such as universal tariffs or aggressive fiscal stimulus. But this explanation doesn't hold up under closer scrutiny. Inflationary policies weren't unique to Trump's platform. Kamala Harris, his opponent, had also proposed several measures that could stoke inflation, including expanded government spending on infrastructure and social programs. Regardless of the election outcome, inflationary pressures seemed likely to persist. This makes it difficult to attribute the Fed's abrupt change to the election outcome alone. Instead, it's possible the Federal Reserve is quietly preparing to combat a brewing crisis or simply signal caution, as if they reconsidered the speed and intensity of rate cuts. However, while the Federal Reserve's decision to delay deeper rate cuts might appear cautious on the surface, it could also intensify some of the very risks that they may be preparing to address. For instance, the commercial real estate market is already under significant pressure from the rapid rate hikes of 2022 and 2023. Higher interest rates have pushed borrowing costs to levels that many property owners simply cannot afford. As loans mature in 2024 and 2025, refinancing at these elevated rates will likely lead to a wave of defaults. This would further destabilize an already fragile sector and could spill over into regional banks that are heavily exposed to commercial real estate loans. On the other hand, keeping rates higher may have strategic benefits in addressing some other potential crises. For example, the US debt-to-GDP ratio presents a long-term fiscal challenge. While high rates increase the cost of servicing national debt, they also act as a mechanism to temper inflation and maintain confidence in US Treasury securities. If investors start to doubt the stability of US debt, a spike in bond yields could trigger a broader financial crisis. By holding rates steady, the Fed may be signaling its commitment to preserving the dollar's value and keeping the bond market stable. Geopolitical risks, like tensions with China, present a different kind of dilemma. Higher interest rates can make the US dollar more attractive, reinforcing its status as the world's reserve currency. This could help counter de-dollarization efforts by nations like China and Russia, who are increasingly turning to gold and other assets to reduce their reliance on the dollar. A strong dollar might also serve as a deterrent in economic conflicts, bolstering the US's financial resilience. However, higher rates come with trade-offs. They can slow economic growth, stifle job creation, and put strains on consumer spending, which is a major driver of the US economy. In an environment where inflation is moderating and the labor market is stable, the decision to keep rates elevated suggests the Fed is prioritizing long-term stability over short-term growth. But whether this approach will mitigate risks or amplify them remains to be seen. The speculation is inevitable as to why the Federal Reserve shifted course so abruptly, deviating from the public-facing criteria it has upheld for years. Until more clarity emerges, uncertainty lingers over the Fed's next moves in 2025. Each adjustment to their projections or unexpected rate cut impacts the gold market, influencing its momentum and investor sentiment. While the structural outlook for gold remains bullish heading into 2025, the market's strength is not immune to surprises. If the Federal Reserve further scales back its support for additional rate cuts and yet another unexpected plot twist, gold prices could face renewed pressure. But what do you think? Why did the Fed change course? And do they have more surprises in store for us? Let us know what you think in the comments. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.